So what I'm going to show you today is my level of understanding of institutional order flow, and this is how we're able to basically um, call market moves, well before they happen. And so everything this week, okay, is all in the recordings. It's on Bounce Back London Open. It's on the Power Hour sessions. If you missed any of those, I highly suggest you go back and watch. Okay. And basically, what I do and what the team does is we look at the markets, right? And we try and find the highest probability trades. And that's kind of where, at least in my development as a trader, when I decided to stop taking every single trade and decided only to take high probability trades, that's when I saw a very big difference in my trading. Okay. So the way that I kind of think of it is like when you go to the store, right? And you walk up to that big carton of apples, right? So what do most people do, or even avocados as well for some of us, right? we walk up to it, right? And then what do we start doing? We start looking for that app, like the fresh apple, right? Like the bright red one, or whatever. We pick it up, we look at it, and we figure out which one we want, right? So if people are that way, right? If you're that way with your fruit, why are you not that way with your finances? Right? Honest question. So when it comes to trading, I personally only like to take the high probability trades. And I get that from higher time frame, right? Higher time frame bias, market manipulation. And if you're late to the party or you're in the trade management phase, you can practice trade management with institutional order flow. Okay, so what I want to do is I want to show you a photo, and this is how I think of it. Okay, so we're going to start off with this. All right. So, and this is just something I ripped off of Google. All right, nothing special. But basically, what this is are people tubing, right? Basically, where you get like a low floaty, or I think that's what you call them. I don't know, tubes or whatever, and you basically float down the river, right? And there's ones in Texas. I think there's ones all over the United States or whatever, or even I think at Disneyland or Six Flags called the lazy river, right? Where basically the water flows in one direction, right? So institutional order flow, right? It's the flow of the orders of the institutions. Okay, it's exactly what it sounds like. But what I visualize in my head is that flowing river. Now, for those of you that are watching this video, if you've ever been into a lazy river or if you've ever been tubing, you would understand how easy it is to go in the direction that the river is flowing, right? It's very, very easy, right? Almost effortless, right? And then at the same time, how hard is it to go against the flow of the river, right? The flow of the water. I mean, it can be done. You know what I mean? You can go the opposite direction, but how harder is that for somebody to do, right? And so basically, it's like trend following almost, but in this case, we're not really focused on the trend. We're focused on what smart money is doing. Okay. So it's the flow of orders from the institutions. Now, how can you understand where the institutions are buying and selling? That's what we do. That's all smart money concepts. Institutional candles, imbalances, equal highs, equal lows, major highs or major lows, right? Where the liquidity is resting at. But on the way there, right? On the way to equal highs and equal lows, that's the flow of the market. And that's where you're going to find institutional order flow. So let me actually see if I can draw it real quick. And this is not going to be the best drawing in the world, so don't be upset about that. All right. Basically, if you have a trade, right, that's down in here, right? So you bought it, right? And over here, there's equal highs, right? There's that liquidity that's resting up here. The flow of the market is in this direction, right? Because and this is based off the photo. Okay, I know it's moving from right to left, but you get what I'm getting at. Okay, on the chart it'll be left to right, but that's the flow of the market. If you're targeting equal highs or targeting a major high of something of that nature, in between the low that was set and the high that it's going to, you're gonna find institutional order flow in the form of what I just told you: institutional candles, imbalances, and everything else that we talk about in the trade house. Okay, I'm not going to go over every single thing. All right, so now we need to get into some examples. So I want you, and this is why I started with this chart first. My markups are not here, and some of you who watched us throughout this week, you already know what I'm about to show you. And I even said that earlier, that we said 3150 this week on S&P. So now, how did we get that? Let me pull out my annotation tool again. Okay. On Sunday/Monday, we talked about this down in here. We talked about that Sunday's gap being an imbalance, right? I usually draw my lines, the imbalances, with the dashed line. Okay. We talked about that being an imbalance. And then we talked about some targets, right? We had a short-term target of right here. What is that? Equal highs, triple highs. What's right above that? For a longer term target, same thing, equal highs, triple highs, resting liquidity. What did Jordan touch on? Right? Round 2, everyone put their masks on. Right? Doomsday. Right? So what is everyone thinking? Everyone's in the mindset of being fearful. Right? Being fearful. So what does Warren Buffett say when others are fearful? To be greedy, right? And so a lot of people don't understand, and even a lot of veteran traders, meaning people that have been around way longer than me, right? They don't understand why the market is booming, but I do, but Trade House does, right? Because we don't subscribe to what most people subscribe to, right? Be fearful when others are greedy, and be greedy when others are fearful. So if everyone's fearful, guess what? Trade House, we're greedy. Guess what? Market booms over, I think it was around 200 points this week. I don't know what the range is for the week, but it's roughly around that. Okay, so let me take this off now. Keep forgetting where it's at. There we go. Okay, so now on the way higher, just like I said, with that picture of the tubing, right? We have the low set down in here, and then up to the very high. In between, that's where you're going to find your institutional order flow. So look for the smart money concepts. They're there. They're on this chart. I'm going to show you in just a second, but I want to give you an opportunity to learn, because if I just give you the answer, right, you're not going to get it, right? But if I show you the way, and then you take yourself the rest of the way, that's what's going to make you an independent trader. That's what's going to make you an independent thinker. All right. So I do want to give you about 30 more seconds to look at this. Look for the concepts that we've shown you in the past. Institutional candles, right? Those down candles before the up moves, they're there. Look for imbalances, they're there. Now, we look for other things like divergence. I don't expect you to know where it's at. I look at this at least for an hour a day, so I know exactly where it's at. That was pointed out earlier this week as well. So I don't expect you to get that one, but everything else I do expect you to get. Okay, so let's go ahead and move forward. I'll show you the markup. Oh, actually, one more thing. Sorry, before we get to the markup, guys, I know that you guys get excited, you're taking notes, and you're posting to Instagram. But guys, please, this next markup, please do not let me see this on Instagram. Okay, please. All right, so let's go ahead and move forward. I know you guys are excited, and I've built up enough anticipation, so let's go ahead and get it. Whew. Excuse me, Red Bull. All right, so like at the beginning, of the week, we told you this imbalance was here. And then also on small time frame, there's equal lows. Those equal lows were swept. Price was able to fill in an imbalance, and we mooned higher. We got really close to these equal highs, right? On a fib retracement, that's about a 618, maybe 78, 6, maybe not quite, but it got close, right? And then in this consolidation here, we told you that this was not a selling off, but rather a lack of buying. There's a difference between shorting and a lack of buying. A lack of buying is going to be casual. Short selling is going to be this. This move down here, that was short selling. This right here, that was not short selling. That was a lack of buying. Okay. And you can just tell from the candlesticks, and that was pointed out. Okay. So go back and watch the recording. Price comes down into what? Institutional candle. Right? Price creates an additional institutional candle here, as well as a divergence with NASDAQ. Boom. Market sets the low, rallies up to this candle here. Now, why am I not labeling it an institutional candle? Because it's not. Well, that doesn't make sense. There was a large sell-off, but this is an up candle. I don't understand. Exactly. That's why you guys should stop going on YouTube and trying to explain it, because you're getting it wrong. LOL. Anyways, so this was, as mentioned as well, a good area to take profit, right? This was a good take partials. Sorry, not take profit, take partials. That was also on the session. How did I know that this quote unquote institutional candle wasn't going to hold? Because it's not an institutional candle. We still have this level up here to go to. So we're going to reaccumulate, right? Where we're going to reaccumulate at? Another institutional candle. Boom. Market rallies higher, and then into Thursday's session, and then into right at the open, right before the open, boom, market comes all the way up to 31.50. That is your profit taking area. July 2nd, I think that was right at unemployment, the unemployment rate, I think. Or was that later in the afternoon? I should know that, but I don't. But anyways, you guys get what I'm getting at. So what is institutional order flow? It's this. It's this right in here. They're accumulating. Excuse me. Right? They're bidding it up. They stopped buying. They didn't start shorting. They just stopped buying. They reaccumulated here. Ran it up. They didn't short it. They just stopped buying it. Reaccumulated it. Rallied it higher. Now you're at an area where they can take profit. Why would they do that? Why would they take profit here and not like down here? Because they need liquidity, right? Smart money needs dumb money. As crazy as that sounds, smart money does need dumb money. Everyone trying to do what? You guys already know. We said it 1,000 times, right? The sell stops that are up here. Smart money, or excuse me, dumb money is buying this, and smart money is releasing their orders to dumb money. And then boom, the market shorts, or not shorts it, the market falls off. So this is the flow of the market right in here. Okay. This is, in my opinion, institutional order flow. It's the orders of the institutions, right? Dumb money is not going in here and setting the lows. Dumb money does not set lows or highs. Smart money doesn't do anything. I mean, dumb money doesn't do anything. Dumb money is dumb money. They're just in there, just screwing it up to keep it professional and to keep it polite. Okay. Yeah. So there you have it. All right. And I'll show you another example before we get into Euro USD and GBP USD, and also how we were able to call the lows for that as well, right? Because this is where the probabilities lie. This is where the probability is at. For S&P, it's a little bit different, but for S&P 500, the major trend is almost always bullish, right? Despite a a flash crash this year, and I think at the end of 2018, majority of the time is bullish. And this is why I don't condone shorting indices that often. We get to shorting indices, but not that often. You can short index futures or whatever you guys trade on these other unregulated brokers, but the bullish divergence is a whole lot more powerful than the bearish one. Okay, because you're syncing with the trend versus trying to catch that market crash. I mean, we've done it, but it's just a lot more work for less razzle dazzle, if you will. All right. So let me show you another chart. And I hope this one isn't the one with the markup on it. Okay, bet. All right. So this is one that we talked about a couple weeks ago. This was also given as well. And I wanna pause it here, and I wanna talk to Jordan really quick to see if we have any questions so far while you guys look at this chart before I show you the markup. So Jordan, do we have any questions, comments, or concerns before we go ahead and move forward?
How would you know if it's not an institutional candle?
Mic off.
Because, well, we kind of answered that one already, but that bearish one that I showed you, because that is a small time frame up candle before down move, when there is a larger objective at play in mind. There is a much larger objective. So why would a small time frame ever outperform high time frame? High time frame is always going to take premise, period.
Yeah, go back to where you have all of that drawing on there real quick.
Okay.
So maybe this can help. This is what I do it with, like colors and stuff, when I'm like labeling institutional candles and whatnot. But hold on, look at it like this. So what if this is a buy? And then what if this is a sell? And the sell goes down, and so that buys and drawdown. And then notice every single spot where John has labeled institutional candles, institutional candles, institutional candles. So this might help you guys view it as which ones are and which ones aren't. Maybe think of it like there's stuck orders right here at the blue candle or at the blue up candle. And when they get out right here of the buy, they're adding on that same buy down here. Or maybe it's spread out between there and here. And so if you think about it, I'll change those. Here, do this and do this. And so if you think about it, that buy is being worked down to where now when everything is TP'd out of here, there's more profit because the buy is right here instead of here, right? And so they're constantly hedging back and forth to work their positions in and out. And so maybe that can help with understanding, but that's like how my brain processes it because there's always stuck orders everywhere.
Mic off.
All right, there you go. So there you have it. And I went ahead and actually added another imbalance as well, just to help clarify a little bit more. And this still does count as institutional order flow, right? Those algorithm rebalancing, okay, that's still an opportunity for an entry. Now, on a personal level, meaning this is the way John Phibb does it. Me, if I can't get like near the low of the week, I typically don't like buying this late. It can be done. This is really more for stacking, like buying back in here and then buying again, and that's fine. But I don't like having my original entry this late in the trend. But this is something to study. This is only on the 1 hour chart, right? Look how many markups we have on the 1 hour chart. You can go into small time frames, and I can almost bet there's other imbalances maybe near these lows or maybe near this low where the institutional candle got a reaction and came back down on small time frame and then shot higher, right? I'm going to leave that for you guys. This is how you're able to get that experience, is to understand how it is that we do things and then go in there and study it yourself. All right. And that's why I wanted to show you this chart so we could do a little bit of studying together. I mean, That's, of course, me presenting. I already know what the markup is because I'm the one who marked it up. But I wanted to give you guys a chance to look, right? So this is the low being set, and then this is the high, right, of this overall price move. So look left. What do you find? Right? During this up move, what do you find? This is probably an imbalance right there. What is this? Small rebalancing, right? What is this right in here? What is this right in here? What is this over here? Right? So let me go ahead and, or if you're in the recording, you can actually pause the video. But since we're live, we're going to have to go ahead and keep it pushing. But here you go. Okay. Very easy. Very, very easy. Okay. There was a low back in here. What do bullish markets usually do before they end up going bullish, right? They need to take out liquidity. Where's liquidity? Below this low, below these equal lows, and then below this low. Boom. That was smacked here. Price rallies higher, leaves an imbalance, reaccumulates, takes off. They didn't rebalance in here. That's fine. They don't have to rebalance every single price level. Boom. Market rallies again. Or excuse me, sorry, it rallies here. My bad. It rallies here, comes back down for a small retracement, right? That retracement is a imbalance. That's institutional order flow. Boom. Market rallies higher. During that run higher, they leave another imbalance. Price comes down. You could probably measure here to here. That might be a 50%. I'm not sure. I'm just trying to eyeball it. Okay. And then boom, market kind of just, this really isn't like very sexy to me, but nonetheless, it finally shoots higher up to the liquidity at equal highs. So there was plenty of opportunities to get into the market. That's the flow of the market. That's institutional order flow. The way that I view it. There might be other people who view it differently than me, but this is my level of understanding. This is how I look at it. That's what I think of when I get into this type of stuff. I think of that river, and I think of those people, sipping beers, floating down the river. That's what I think of. Okay. But yes. So now we're going to go ahead and get into Euro USD and GBP USD, unless we have something to go over.
Mic on.
I don't know if you answered that question that I put into the chat, but that was, I believe,
I
the
didn't.
Mic off.
Is the order flow like Elliott wave, as where you take profit at wave 5 could be correction pattern ABC? Okay, number one, I don't look at Elliott waves. Number two, I don't look at ABCD patterns. An ABCD pattern is literally just like the 200 price extension from the fib. Okay, everything, all of that. Okay, I'm just going to call it nonsense. Okay, because that's what it is. All that nonsense is just revamped Fibonacci levels. That's all it is. Elliott waves, I don't use Elliott waves because you could put 100 people in a room. You could put 100 traders in a room, and all 100 of those traders could be Elliott wave traders. You could have them mark up the same chart, and you'd get 100 different markups for Elliott waves. They're very inaccurate. They're only accurate in hindsight. Maybe sometimes here and there they're live, but ultimately I think it's all garbage. What we're showing you here, let me go back to this markup. What we're showing you here, this is precise. This isn't guesswork. Well, I mean, at the time, sure, you're taking probabilities. Nothing is 100%, but Elliott waves are not going to give you 1 point of drawdown, 2 points of drawdown for like 30 points of profit and things like that. Elliott waves can't do that. Okay. So not trying to be mean. I'm just saying. All right. That's my take on it. But now, okay, so now we'll go ahead and hop over onto Fiverr, which is Euro USD. Now we were, I think, right here on the session. I think price our London session was right here. Okay, so looking at this price action, sorry, it was right here somewhere because it was later in the session. Looking at this price action right in here with unemployment coming within the next, I think, like 5 to 10 hours, something like that in that range. right? We're looking for market manipulation, right? And where are they going to manipulate price? Lows, highs, right? And so looking at this, well, price already made a higher high here, right? So if they took that liquidity, well, we don't need to go higher than that. I mean, we probably will, but I'm just saying, like, all right, we've already gone to the upside. We need to look for downside objectives, but we need to wait for that break of structure before we enter, right? So then what happens? We do end up going higher here, right? And then price comes down and then retraces. And then it comes down to what? Oh, did I delete the markups? Oh my God, what a joke. All right, equal lows are right here. Boom, that was given. There's another set of equal lows right here that were given. Boom. The market for that day, yesterday, right? Perfect target of equal lows and of later equal lows. And actually this low was given as well. Now, how do you know? Right? John, how do you know what's going down to those equal lows? Number one is experience. I've seen this setup happen, if not hundreds of times, thousands of times. Okay. Number two, if you go out to the 1 hour, right? During this run higher, we never got our deep retracement. So during this run higher, what do you think this is right here? That's an imbalance, right? So even though price is way up here at 113, which, by the way, if you're taking notes, actually took liquidity from previous week. Ooh, sauce, right? So price took liquidity up here, and then we get our break of structure on small time frame, retracement, yoink. Right? Now, the equal lows, this was easy, right? This was very close. You could have targeted down here, but this was very close, and this was small time frame, so that's why we gave you that. In addition to that, we also called GBP, and that was the same reason, right? GBP is the one I have the markup on, and of course I get rid of it on Euro. GBP, we also told you this. You had equal lows right here, and what was resting below the equal lows? The imbalance. So for those of you asking, and we actually got a question earlier this week or last week, how do you know which imbalance it is? How do you know which imbalance is going to be hit and which one's not going to be hit? The perfect imbalance, and I'm going to say this once, the perfect imbalance is one that's resting either below equal lows or above equal highs. Backtest that.
When you are targeting equal lows or equal highs, should you set your take profit above or below them? Think about it like this. Okay, he's talking about, okay, you got equal highs or you got equal lows. There's resting liquidity above or below that. Big money, like what we're showing you is not by choice. Like it has to be done. Big money has to approach the market in this manner or they're going to struggle a lot more with executing their orders, right? Institutional order flow. They have to order flow everything this particular way because they trade with so much freaking money, right? And so the short answer to your question is yes, but I'd rather you understand why. Okay, in these areas, right? Just like in the course, we call it a pocket of money. The reason why is because in this area, there's so many different opinions in approaching this area with stops. Okay, it's injecting quote unquote liquidity into the market. So whether if it's a buy stop or a sell stop, stop losses, take profits for other people, like there's so much order exchanging going on in here. And so why we look to TP in those areas or enter in those areas when other people are being rated out, it's because this is where smart money or big funds will shop for their orders because inside these areas, it allows them to fill their orders a lot more. Okay, and I don't know if you want to add on anything to that, but
Well, the only thing I have to add is I think it's better if you actually go back and watch the recording, because we actually go ahead and either
Mic
add or
off.
subtract to the nearest whole number. And you know, I mean, I could tell you how to do it. I think it's just easier for you to actually watch us do it. If we actually go back to the index futures for a second, okay? The reason we said specifically 3150, if trading, oh, there we go. Trading View usually has an issue with slapping it to the whole numbers for me. But the reason that we call 3150, and that's why I said, even though it did push past it a little bit by 7 points, that's fine, is because it's above equal highs and it's a rounded number, right? 3,100. The next whole number is 3,200. Now that's way up here. I'm not going to expect for the market to go all the way to 3,200 this week. Maybe this month, and maybe for the month of July, but not for this week. So what's a more reasonable level after 3150 on let's see, on GBP. On GBP, below the lows, and I could be wrong, but I think we called out either 2450 or 2440. I don't remember which one it was, but why 2450? It's inside the imbalance. Why 2440? It's the nearest rounded even number that's in the middle of the imbalance. And I think for Euro USD was 1240. I think that was all. It all happened so fast. I don't remember, or even 1250. It was one of the two, but that's why, is because it's just literally, if you're taking notes, it's just the next available whole number after the equal lows or highs, whichever one is nearest. Okay, backtest that. You have a lot to backtest at this point, right? We gave you institutional order flow, we gave you all of these markups, and we just gave you how to pick price targets based off of equal highs and equal lows. And we gave you the most powerful imbalance. So you guys got a whole lot today. You may not realize it, you may not understand it, but you just this stream was a gold mine, period. And I'm not trying to like pump myself up or fluff or none of that. I'm just saying you guys got a lot today. Okay. So but yeah, whole lot of homework for you guys. And look at that, we're already starting on our homework, doing a little bit of back testing as well for some of you guys. But yeah, that's my follow up with that. 80s, 20s, and 50s. And some of you know what I'm talking about because you guys are on the sessions, right? You're on the Bounce Back London Open with me, right? So you guys know 80s, 20s, and 50s. But yeah, that's it. But yeah, so go into this. Take your box tool, go onto SPX 500 or whatever janky way you get your S&P 500, and draw the box from the high to the low, right? Whatever color box you want, it doesn't matter. And then play around on different time frames inside of this box, right? Go to the 30-minute, go to the 5-minute, go to the 1 minute, and just look around. Just look around. All right, that's all you gotta do. But I mean, obviously, look for what we tell you. But I'm just saying, go mess around. Go have some fun. Okay. What I like to do, honestly, pull up YouTube, right? Pull up your favorite music, and just have fun with it. Don't make it boring. Sometimes I like it when it's boring, but you know, personally, I think I'm a little bit different from most people. But just cut some music on and have fun with it with your back testing. Go do that. Yep. You guys know what that is right here. There are tons of markups on this chart that I haven't marked up, and I don't need to, but there are a lot. Okay. There's a lot. And you can also do the same thing with US 30 and NASDAQ, because we haven't even touched NASDAQ today. Even though the NASDAQ was in divergence here, we haven't even looked at NASDAQ. So that's your homework for this week. If you want to, it's all optional. I don't care if you do it or not. I wish you would, though. That is your introduction to institutional order flow. Okay, the flow of the market to longer term price targets. That's the way that I look at it.